Welcome to today's analysis, where I dissect the economic undercurrents driving global markets and spiraling industries in a style sharp, sometimes sarcastic, reminiscent of the commentary on Boss Economics World. Today, we'll discuss the recent whirlwind on Wall Street, the French budget debacle, stress tests on major financial institutions, tech companies battling regulation, and more. The news of tech MNCs like Broadcom and AMD surging on Wall Street is hardly surprising, and as we like to say here, it's a sugar high more than any sign of real, grounded growth. The S&P 500 reaching over 1% gains on news of an administration probe into Chinese-made chips is the latest sugar rush investors need to keep the good times rolling. Here's the magic trick, with institutional investors heavily overweight in tech stocks, they'll seize on any excuse, like the Santa Claus rally, to make those end-of-year portfolios look juiced up. Because isn't that what healthy economies do? Instead of worrying about fundamentals, we're more focused on seasonal rallies and temporary boosts. And honestly, with Nvidia and Broadcom leading the charge, how much of this is real demand, and how much is just panic buying before regulation catches up? But let's face it, President Biden's probe into Chinese chips didn't really come out of nowhere. This is part of a larger chess game being played between the US and China, where semiconductors have become the new pawn in an economic war. While America's tech stocks rally, China faces restrictions on its industrial capacity, but you know what they say, one man's recession is another man's rally on Wall Street. And it conveniently dovetails with long-term plans Trump may carry forward into 2024, provided there's no bigger clamor for decoupling our technology sector from Chinese suppliers. Now, let's talk about interest rates, a perennial thorn in the side of economic forecasts. Investors don't want treasuries associated with US government debt. Yields on long-term debt are rapidly rising. This is central to the problem, not just a technical glitch. Look closely, and you'll see the underlying trend. A steepening yield curve hints at entrenched concerns about future inflation, tightening credit markets, and how the Federal Reserve's cycle of rate hikes or cuts won't end well. Lurking in our 2025 economic future is a fear of more rate hikes. Let that sink in after everything we've seen. Think about the average person's savings and investments. With rising yields on long-term treasuries, why hold riskier assets if government debt promises higher returns? There's now less inclination to indulge in risky equities, unless you happen to be one of the savvy institutional whales like the pension funds leveraging outsized bets on big tech via complex derivatives. Switching continents, France gives us a fresh scandal, yet again. Yes, France, the country that believes it can outrun its fiscal issues by dodging EU guidelines. Unsurprisingly, the country's debt surged to 6.1% of GDP, far exceeding the EU's required deficit limit of 3%. President François Bayrou is now tasked with shrinking the deficit to 5% while negotiating a budget likely to enrage every political faction, both left and right. This complex political situation mirrors other European economies, high structural debts, overspending, and the inevitable fiscal tightening headed their way. Here's the bottom line, France's financial woes aren't outliers. They're symptomatic of a Eurozone facing one crisis after another as fragmented politics and unsustainable debt levels collide. Imagine the consequences, France slipping closer to a European debt default, with implications echoing across the continent. Combine that with EU rules not accommodating countries in permanent states of crisis, Italy, Greece, and you've got an impending fiscal disaster on hand. France is resting on thin ice, and its fiscal struggles could easily mirror Greece's 2010 debt crisis, except this time the entire Eurozone could catch the cold. Meanwhile, back in the States, the Federal Reserve gets dragged to court by the banking cartels, and no, that's not an exaggeration. JP Morgan, Goldman Sachs, and Bank of America, household names embroiled in global financial misdemeanors, feel they've been treated too harshly with modern stress tests designed post-2008. These tests were supposed to save us from another global meltdown, yet now the titans of finance are suing for transparency. This is just another sign of how regulation has become toothless, created behind closed doors, and largely dictated by those supposed to be regulated. But what's the crux of the issue? Collusion between government and big business. When it comes to setting rules, it's a small wonder we even pretend to believe in the sanctity of these stress tests. They're designed to give the public a feeling of control while keeping the status quo untouched for these big banks. For anyone not paying attention, ask yourselves, why do banks hate stress tests? Simple, these tests run the risk of revealing that major institutions may not hold anywhere near as much net capital as they claim. Their overleveraged positions on volatile debt markets could blow up at any minute. With rates potentially on the rise again in 2025, yet another debt bubble may silently be swelling beneath the surface. And while we're on the subject of surreal events, American Airlines, like Amtrak, threw a wrench into a purely American saga of holiday chaos. Travel chaos due to cold weather, technology glitches, external service providers, how very 21st century America. Instead of addressing aging infrastructure and digital vulnerabilities, major corporations like DXC Technology, which maintains flight operating systems, continue to overpromise while the airline industry passes on the blame to glitching software. Sounds like a textbook way to obfuscate the inherent flaws of an unregulated industry driven by profit margins over service quality, doesn't it? It doesn't end here. Hello, DXC. You may not know them, but this third-party vendor just joined the ranks of companies being blamed for logistical chaos. It's almost laughable that the very glue holding American Airlines flights together is cracking, and where is the accountability? In a highly competitive, deregulated industry, corner-cutting on infrastructure has become a systemic issue. What about the gig economy? In today's brave new world, you aren't an employee, you're a customer. Lyft is suing San Francisco for $100 million, claiming they were wrongly taxed. Their argument? Drivers who work for Lyft aren't employees, they're customers, an absurd claim, even for the gig economy. What Lyft is doing is part of a larger trend seen across platforms like Uber and DoorDash to avoid dealing with pesky obligations like benefits, paid leave, or insurance. It's all about one thing, profits. Forget workers' rights. The gig economy's business model has always been predicated on manipulating the classification of laborers to minimize the costs of employment. But as San Francisco claws back tax revenue from giant platforms like Lyft, one must ask, how long can this system last? It points to deeper, systemic tension between platforms, taxation, and workers who are being squeezed dry on every front. Finally, there's quantum computing, the whisper of the future. Google's subsidiary Alphabet marked a breakthrough, and suddenly, funds like Defiance Quantum ETF are surging. Like flipping a light switch, investment flows poured into the ETF, which had otherwise remained quiet. But this sudden interest is less about breakthrough technology and more about overhyped speculative bubbles that will eventually pop. Sure, quantum computing is crucial for AI and advanced data processing, but the racing market hype serves as bait for institutional investors looking to ride high on speculative trends. Remember the dot-com bubble? We are seeing something eerily similar as retail and institutional investors collectively race to board this train, though most will likely discover quantum technology's long payoff timeline too late. Trump's return signals a possible reversal of Biden's decarbonization strategy. However, regardless of what administration hopes to push, the energy market operates on numerous forces, political, technological, and global. Look closely at oil prices, nuclear energy advancements, and China's aggressive push towards renewables, and see why a government alone, even one determined to revoke environmental regulations, is unlikely to throttle the energy transition completely. Yet, the short-term damage is real. Investors are now hedging their bets. Will tax breaks for oil drillers return? Will we see tariffs on electric vehicles? The market chaos fueled by erratic policy changes is profound. And that's good news for day traders, but an environmental disaster for the future of the planet. And Ecuador, oh boy. President Noboa is looking to consolidate power, avoiding Vice President Veronica Abad by ordering her to temporarily relocate to Turkey. The ensuing political fireworks are now part of a larger regional struggle in Latin America over populism, economic crises, and the overreach of leadership. There you have it, ladies and gentlemen. What we've painted today is not just energetic blusters of Wall Street highs, stress tests conflicts, or French deficits. They're signals of a global reckoning with unchecked debt, regulation avoidance, climate destruction, and colossal corporate greed, along with forthcoming economic disarray that no short-term gains can mask for long. Until next time, stay alert, stay critical, and don't fall prey to the fleeting highs of the market while ignoring the undercurrents likely to shape your everyday reality in ways that tickers and bubble bursts never will.